Broadcom stock has been one of the biggest winners of the AI boom. But now the question is, has the easy money already been made? Or is this still one of the best compounders in semiconductors? Broadcom isn't just another chip company. It's a critical supplier powering the infrastructure behind AI, data centers, and global connectivity. I met with Galstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Let's break down Broadcom using our 5 key factors to determine whether it's undervalued, fairly valued, or overvalued. We'll analyze its economic moat, return on capital, growth, financial strength, and valuation. Now let's start with the moat. Broadcom has a wide economic moat, but it's not obvious at first glance. It's built deep inside the infrastructure of its customers. Unlike most semiconductor companies, they don't sell off-the-shelf chips. They design highly specialized custom solutions for hyperscalers and large enterprises. And once those chips are embedded into a system, switching away becomes extremely costly and risky. It's not just replacing a supplier, it's redesigning entire architectures. That creates very high switching costs. What really sets Broadcom apart from peers like Nvidia or AMD is that it's no longer just a chip company. Through acquisitions like VMware, Broadcom has added a second engine, infrastructure software. This is the software companies use to run their IT systems, everything from data centers to cloud environments. Once it's embedded, it becomes very difficult to replace, adding another layer of switching costs. So instead of relying purely on chip cycles, Broadcom combines AI-driven hardware demand with stable, recurring software revenue. That leads to deeper customer relationships, stronger lock-in, and a more resilient business model. It's not the flashiest moat, but structurally, it's one of the strongest in the space. Now, before we go into the numbers, this is where the story needs to be backed up by data. To break down Broadcom's return, growth, financial strength and valuation, I'm using Fiscal, the research platform I personally use. If you want to follow along with the same charts and peer comparisons, the link below includes a 15% discount at no extra cost to you. Returns on capital tell us how efficiently management turns investor capital into real profits. Broadcom has a return on invested capital of 17.1%, and return on equity of 31%. Now if we compare this to peers, for return on invested capital, Nvidia stands at 175.1%, Qualcomm at 14.9%, and AMD at 6.6%. Let's be clear, Nvidia is in a league of its own right now, but Broadcom still delivers strong, consistent returns, outperforming Qualcomm and AMD. Next up, return on equity. Nvidia sits at 119.2%, Qualcomm at 23.3%, and AMD at 7.1%. Again, Nvidia dominates, but Broadcom stands out as a high-return, capital-efficient business, especially at its scale. These are elite-level returns, even if they don't match the current AI leader. Consistent growth is the fuel that drives a long-term compounder. Without it, even a dominant business eventually stalls out. This is where Broadcom really stands out. I'm using figures since 2017, as 2016 was an outlier year. Revenue grew in this period at a compounded annual growth rate of 17.4%, net income grew at a CAGR of 37.7%. Earnings per share grew at a CAGR of 36.2%. That's explosive earnings growth, especially for a company of this size. Now compared to peers, Nvidia sits at 61.2%, Qualcomm at 15%, and for AMD we can't compute it due to negative earnings in 2017. Broadcom sits right behind Nvidia, but importantly, with more diversified revenue streams. One thing to note for Broadcom is that earnings per share growth is slightly lower than net income due to share dilution of roughly 2.8% per year. That's a small negative, but not enough to derail the overall growth story. This is high-quality, scalable growth, driven by AI demand and strategic acquisitions like VMware. Financial strength is our sleep-at-night factor, ensuring a company can survive a crisis and continue to out-invest its rivals. Now let's look at the balance sheet. Total cash and cash equivalents sit at $16.2 billion and total debt at $65.1 billion. So there is some leverage here. Debt to equity is 0.8, down from 1.7 in 2022. So at first glance, that debt looks high, but context matters. A debt to equity below 1 is generally healthy. Between 1 and 2 is moderate leverage, and above 2, you're in a potential risk zone. Broadcom at 0.8 is now in a healthy range, especially considering strong cash flows and an improving leverage trend. This shows disciplined capital allocation after acquisitions like VMware. So while Broadcom uses leverage as part of its strategy, it's controlled and improving, which is what we want to see. Even the greatest companies can be poor investments when investors overpay. So how is Broadcom valued today? Broadcom trades at a forward price to earnings of 22.5. Historically, the median has been around 14.8, the highest point was at 45.7 and the lowest point was at 7.6. So yes, on a historical basis, this is not cheap. But if we compare to peers, Nvidia trades at a forward price to earnings of 20.2, Qualcomm at 12.2 and AMD at 30.4. So Broadcom sits right in the middle. Now let's adjust for growth by looking at the price to earnings growth ratio. Based on long-term analyst earnings per share growth estimate of 40.3%, the forward PEG ratio is 0.6. That's very attractive. Now let's look at the trailing PEG ratio. The trailing price to earnings ratio is 58.8. And if we look at the historical earnings per share growth of 36.2%, we get to a trailing PEG ratio of 1.6. That's not necessarily cheap. Based on the forward-looking valuation, Broadcom is undervalued relative to growth. If we look backwards, it's fairly valued to slightly expensive. This tells us the market is pricing in continued strong execution. Let's wrap up across our 5 key factors. Broadcom has a wide economic moat driven by switching costs and deep integration. Return on invested capital of 17.1% is strong, even if below Nvidia. Earnings per share growth is exceptional at 36.2% CAGR since 2017. Leverage is at healthy levels with a debt to equity ratio of 0.8. With a forward PEG ratio of 0.6, valuation is attractive when adjusted for growth. In my view, Broadcom is a high quality compounder that is undervalued, especially if AI-driven growth continues.